Over the last 10 years, the S&P 500 has been on a tear, but the experts are saying that that is about to end. In the past decade, the S&P 500 has had an annualized return of over 13% per year, but now Goldman Sachs believes that the next decade is going to bring returns closer to only 3%. To put that in perspective, if one was to invest $500 per month for 20 years at that 13% per year, they would end up with almost $500,000. Conversely, if they were to invest that same $500 per month for 20 years, but at the new 3% rate instead, they would end up with only $161,000. That is a huge difference.
In 8 of the past 10 years, U.S. stocks have outperformed the rest of the world's stocks, but the decade of big gains has come to a close. At least that's according to a new note out from Goldman Sachs. Strategists expect the S&P 500 to post an annualized nominal total return of just 3% over the next 10 years.
So Goldman Sachs is saying that the S&P 500 is going to have annualized nominal returns of just 3% per year. This is the most bearish case I've ever heard, but let's just humor them for a second. And let me give you real numbers. Now, if the S&P 500 were to only grow at 3% per year, that's not ideal. But remember, it also gives out a dividend of about 1.23%, which again isn't amazing, but just stick with me. So let's say you've been investing for a little while, and you have about $100,000 in the S&P 500 today. Your annual contribution is gonna be $6,000, which is basically $500 per month. The dividend is 1.23%, but on average, the dividend growth is about 5%. As you can see here, for 2024, it was 5.9%. So let's just put 5% here. Remember, we're gonna go with the lowest bear case possible and say the S&P 500 is only gonna grow about 3%. These are the real numbers. The ending balance would be at about $226,000, with a total return of 41.46%. The total dividends over that time period would have been over $20,690. That's the thing people keep forgetting about, and you need to keep this in mind. Even with a very low rate of return like 3%, hopefully you'll be reinvesting those dividends, and with that you're going to be compounding interest and it's going to keep growing. Now on to the next important topic with this whole Goldman Sachs forecast. Goldman Sachs is reputable and it has been around for a while. But let's just temper expectations for a second. What did they say last year in 2023 about how the S&P 500 was going to do this year in 2024? Goldman Sachs said the S&P 500 would rise just 6% total in 2024. They said the S&P 500 index is expected to rise to 4,700 by the end of 2024. Remind me again. Where are we at now in October of 2024? Are we at 4,700 for the S&P 500? Oh, that's right. We're at 5,797. A full 1,000 higher than the experts predicted. Did we rise 6%? Oh, that's right. We've risen over 22%.
Let's talk about what they're factoring in, Maddie, here. So in the model perspective, long-term equity returns as a function of 5 variables. Within those variables is a starting absolute valuation, stock market concentration, economic contraction frequency, and then they go on to talk about corporate profitability and interest rates. So it's 5 things that we have very much been talking about with a number of economists and obviously strategists here over the last several months and several quarters. Now, in terms of what they're looking at going forward, their forecast suggesting equities are going to face some stiff competition from other assets over the next decade. And you might be asking yourself, what would be that better bet? They go on to talk about the fact that they see the S&P having a roughly 72% probability of trailing bonds, 33% likelihood of lagging inflation through 2034. And then, of course, they talk about that concentration really has a significant role in some of these projections.
Did they just say that the S&P 500 is going to lag bonds over the next 10 years? I don't think I even need to address that because that's absurd. The one thing I do kind of agree with is this idea of concentration. And when they say that, they're basically saying that right now the S&P 500 is very concentrated within those tech stocks, the biggest stocks and the most amount up at the top 10 really of that whole S&P 500 is very much concentrated in those fun tech stocks. If there really is somewhat of a bubble forming in AI or tech, then that high concentration in those types of companies does pose some risk.
Yeah, and they talk about that concentration leading to a lot of the over 20% rally that we've seen over the last year here, of course, but they say that a broadening out, while they do expect that to happen, clearly they don't expect it to be enough to lead to those broader gains, which I think is fascinating given that they do expect more growth in something like the market cap weighted benchmark index, rather the equal weighted S&P than the market cap weighted index. They expect that equal weighted S&P to outperform the S&P.
So what she was saying, and some experts have been saying, is that the equal weighted S&P 500 index might outperform the market cap weighted S&P 500 index. A good ETF for the equal weighted S&P is RSP, which is the Invesco 500 equal weight ETF. This one is up about 13% for the year to date, whereas the normal market cap weighted S&P 500 ETF VU is up a little over 22% for the year. The idea of investing into an equal weight S&P 500 fund is definitely one to consider because this approach results in an exposure that tilts towards smaller companies in the S&P 500 index, and relative to market cap indexes like the S&P 500, this reduces the concentration risk. For me, I definitely do agree that the other types of companies within the S&P 500, basically the non-tech companies, the boring companies, but more sustainable and safer style companies that have been underperforming lately, will be growing bigger and stronger in this next decade. For me personally though, I'd rather continue investing in the normal market cap weighted S&P 500 index, but then invest in those value style companies within a value fund that's specifically for that. And I'd want one with a solid dividend and that has a good solid growth within that dividend year after year. You all know which one this is, and that's SCHD, which is the Schwab US Dividend Equity ETF. I've been saying this for about 6 months now. I believe these types of companies that are within a fund like SCHD are going to be the ones that do really, really well, especially in this next decade. And Goldman Sachs is basically saying that exact same thing.
Yeah, and I think this also just signals the fact that investors potentially, if this call is right, certainly do have to adjust to this new normal. We've been talking about the massive outperformance, the unpredictability, or really the surprise maybe that we have seen in the outperformance and how long we have seen this resilience play out within the market. So they're still saying that there is ways to make money and there is reason to be optimistic, but it's just not going to look like anything like it has over the last several years.
That last part was so key. The next decade will look much different than the last decade. I get asked all the time, if growth funds and semiconductor funds are growing at such a high rate and they're getting 18 to 20% every single year, why not just go with those in your portfolio and make it just fully that, especially if you want to get rich faster? Well, market cycles are a thing, and it never stays one thing for very long. It'll be growth for a while, then that'll kind of level out and even possibly drop a bit, and then at that point its value's turn to shine, and then it kind of drops out and then levels out, and it keeps going from there. The tech and growth funds have been on fire, but now it's time to stay cautious with those and be looking at what is going to be the thing that's going to be on fire next. This is why my updated 3-fund portfolio is the best thing for anybody to be invested in, because it doesn't matter what the market's doing, at least one portion of the portfolio is going to make it so that you get the highest highs, and it's going to keep you safe from hitting those low lows. Check out this video to learn more about that updated 3-fund portfolio, or watch this video to keep you going strong in your investing journey.